In case you're wondering, yes, my nails are painted. My 3-year-old daughter decided to paint my nails, so hopefully they don't distract you from this video. So here we go. I mean, most business owners think selling the business is the holy grail, and I definitely get that. You built something, you took the risk, you dealt with it, payroll, employees complaining, customers complaining, taxes, stress, blah, blah, blah. All the problems that you didn't even think of, and probably a lot more, and no one's going to understand exactly what you went through. So when someone comes along and says, hey, I want to buy your business, it can feel like the finish line, like the reward for everything that you went through. And in many ways, it could be, but there is another side of that transaction that does not get talked about enough. And when you sell the business, you're not just receiving a check. You may also be giving up the cash flow that supported your lifestyle prior to the sale, and that cash flow that supported your family, your lifestyle, your future plans, and in many cases, who you are. And that cash flow is the lifeblood of the business that you built. And after the sale, that lifeblood has to be replaced by a new kind of plan. So the question is not just how much can I sell this thing for? The better question is, what does this money now need to do? And that is what the liquidity event planning is really about. It's not just about the transaction. It is about the transition. And before we get into any of this, it's quick to note that this video is for informational and educational purposes only. It is not investment advice, tax advice, legal advice, and it's not an accounting advice. And every business owner situation is a little bit different. And before making decisions around a business sale, succession, recapitalization, estate plan, investment strategy, or major liquidity event, blah, 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 consult your own CPA, attorney, financial advisor, and any other qualified professionals. Okay, now that I got this cool disclosure out of the way, let's talk about business owners often miss. A lot of owners prepare for the transaction. They think about the valuation, the purchase price, the buyer, the deal structure, the letter of intent, and the closing date, and how much you're going to pay in taxes, all these legal mumbo jumbo, and all that really does matter, but the transaction is not the same as the transition. The transaction is the deal, and the transition is your life after the deal, and those two things are very different. Because after the sale, you may not have the same business cash flow coming in every month. You might have a lot more in your bank account, but you may not have the same schedule. You may not have the same level of control that you're used to, and you may not even know what Monday morning is supposed to feel like anymore. And that is why I believe business owners should think about liquidity events planning before the money changes hands. Not because business selling is bad. Selling may be the right move, but a big check can solve one problem while also creating several new decisions for you to make. And that is really where the real work begins. And here's a question I think more business owners need to ask. If someone's willing to buy your business for a significant amount of money, why? I'm not saying it to create fear. I'm saying it that because businesses usually don't write large checks for no reason. They see something, and they may see some market opportunity that you may not see. They might see improvements to your operations. They might see leverage. They may see future value. They may see something in your business that you may not have fully considered yet. And again, this does not mean you should not sell. It just means you should understand what you are selling. Because too many owners focus almost entirely on the price. And the price does matter, but the price is not the only question. The better questions are, one, why am I selling? What am I giving up? What am I gaining? How will future income needs be supported? And how will I manage this new asset? And what is going to happen to your identity after the business is sold? And what decisions need to be made before money changes hands? That is the difference between preparing for a payday and preparing for a transition. One of the hardest parts of a liquidity is that it creates a lot of decisions at the same time. And those decisions are all connected. Taxes, estate planning, investments, concentration risk, family communication, lifestyle, charitable intent, business identity, advisor coordination, timing, boom, boom, boom. And it's a lot to solve for one person. And they have several issues that all affect each other. A tax decision may affect an estate planning decision. An estate planning decision may affect a family conversation. An investment decision may then affect future cash flow. And then the cash flow decision may affect lifestyle. And then the lifestyle decision may affect how the risk of an owner is comfortable taking with everything. And all these conversations are happening separately, simultaneously. And then the owner ends up with a collection of advice. And it's like, no, why did I sell this thing? I should have just stayed where I was at. It does not mean that like your CPA, attorney, your M&A advisor, business broker, exit planner, or financial advisor did anything wrong. They each have their own lane, but the owner's life does not happen in lanes. The owner lives in the intersection, and that intersection is where liquidity transition plan matters. One of the biggest mistakes I see is owners waiting until after the deal to organize their personal financial life. I do not say that as criticism. It makes sense that you're busy, the transaction can take over everything in your life, and there are documents, calls, hostile negotiation, advisors, terms, deadlines, due diligence, and 1,000 other things flying at you all at once. So the personal planning gets pushed to the side. But here's the issue. Some decisions may be easier to coordinate before liquidity than after liquidity. Some family conversations may be better started before wealth becomes more visible. Some tax, estate, charity, and legal questions may require time with qualified professionals. And some investment decisions should not be rushed right after a major financial event. And some lifestyle decisions are easier to think through before the money arrives. So the goal is not to predict every single detail. No one can do that. The goal is to identify what needs attention before, during, and after liquidity. So you're not forced to make every financial decision at the exact same time. And that is exactly why I created a liquidity transition framework. It is an educational tool for business owners who may be preparing for a sale, succession, recapitalization, retirement from the business, etc., or whatever may be happening in your life. It's not designed to tell you everything under the sun, whether you should sell or not. And it does not guarantee a better sale outcome. It also doesn't guarantee lower taxes. I'm not a magician. I just have the magic 8-ball here that helps me. It is designed to help business owners ask better questions before one of the most important financial transitions of your life happens. And the goal is to help identify hidden gaps and organize the hard questions and create a clearer process before, during, and after liquidity. Think of it like a decision map, not a magic answer, a map. Because when the numbers get bigger, the decisions do not automatically get easier. They usually get more connected. And the framework has 5 parts. Part 1 is pre-liquidity clarity. And this is where the owner needs to slow down and ask, what do I actually want this transition to accomplish? Not just what is the business worth, but what does life look like after this? How much is enough? Do I want to retire? Do I want to stay involved in some sort of way? Do I want to start something else? Do I want to reduce risk? Do I want more time with family? All valid questions that you need to go through that aren't even money related in any sort of sense, because a sale is not automatically success if the owner has no idea what the money is supposed to do. Pre-liquidity clarity is not about having perfect answers. It's about knowing which questions matter before the transaction creates pressure. Part 2 is tax, estate, and legal coordination. This is where owner's professional team becomes extremely important. And your CPA may be thinking about tax implications. Your attorney may be thinking about legal structure, estate documents, trust planning, or transaction terms. And your financial advisor may be thinking about cash flow, investment strategy, liquidity, and long-term planning. All those perspectives definitely matter, but they need to connect. The question is not just, do I have a CPA? The question is, are the CPA, attorney, advisor, transaction professionals working from the same set of assumptions? Because a liquidity event can affect tax planning, estate documents, ownership structure, charitable intent, family planning, and investment decisions. You get where I'm going with this. And again, it's not legal or tax advice. The point is that these questions should be coordinated with qualified professionals early enough that the owner may still have more planning flexibility. And part 3 is investment and risk transition. Before liquidity, many business owners have a large percentage of their net worth tied into one single asset, the business. And that concentration may have created the wealth, but after the transaction, the risk changes. Now the question becomes, how do I manage personal balance sheet that may need to support my lifestyle, family, taxes, future investments, philanthropy, and long-term financial needs? And this transition can be more emotional than some people expect, because when your wealth is in the business, you may feel control. You know the team, you know the products, you know the customers, you know the market, you know the problems. You've been doing this. You can pull every single lever. But after a sale, you may be managing a pool of assets that feel less familiar. And that does not mean that one is better than the other. It means the transition deserves a plan. And some questions to ask are, how much cash should remain accessible? How much should be invested immediately? What risks have changed after the sale? And what level of volatility is appropriate now? And how is your future income need to be supported by the portfolio? And those decisions should not wait. The goal is to not chase performance after the deal. The goal is to create an investment approach that fits the owner's new reality. Part 4 is family lifestyle and identity. And this part has a lot of traditional planning misses, because liquidity does not only change the balance sheet, it can change family expectations. It can now change how people treat you. It can change what your spouse, children, or extended family assume. It can make you feel responsible for more than you should and how you see yourself for years to come, because the business has been the center of your world and your calendar was built around it. Your conversations were built around it. Your stress was built around it. Your purpose was probably built around it. Then the transaction happens, and then suddenly the thing that gave your life structure is completely different. And some owners feel relief, some uncertainty, and some feel it's like loss, the pressure to immediately do the next thing. And none of that is wrong, but it should be named, because financial planning that ignores the human side of liquidity is incomplete. And the money matters, but so does the life. The money is supposed to support. Part 5 is post-liquidity operating plan. The first 90 to 180 days after liquidity can be strange. The deal may be done. The pressure may be gone. The money may have arrived. You got the wire. And now you're starting to get approached. New investment opportunities, requests from families, requests from charities, new business ideas, real estate deals, private investments, lifestyle purchases, people with opinions, and some of those may be worth considering, but many do not have an immediate answer. And that is why the first months after liquidity should not be improvised. And the question is, what needs to happen in the first 30 days? What needs to happen in the first 90 days? What should wait 180 days? What should be reviewed on an ongoing basis? And the purpose of this stage is not to solve everything. It is to avoid reacting to everything. And a lot of owners ask, what should I do after I sell? That is a reasonable question. But I think a better question is, what should I clarify before I sell? Because the best time to think about the life after liquidity is usually before liquidity happens, before the deal closes, before the wire hits your bank account, before family expectations change, before reinvestment decisions are made, before tax, estate, lifestyle, and investment questions all show up at the same time, because a business sale, succession, recapitalization, or a major liquidity event can be one of the most important financial transactions of your life. It deserves more than just traditional planning, because a big check can solve one problem while creating several new decisions for you to make. And the goal is not just to get paid. The goal is to understand what that money now needs to do. And if you are thinking about selling your business, preparing for succession, or approaching a major liquidity event, start with the liquidity transition framework. It is designed to help you clarify why you are selling, what you may be giving up, and what you are gaining, and what needs attention before the money changes hands. And you can request the framework at liquidityframework.369financial.com. After completing the framework, if you want help thinking through how these questions apply to your situation, you could request a liquidity transition review. Again, it's educational. Before making decisions, work with your accountant, CPA, attorney, financial advisor, qualified professionals, pastor, rabbi, shaman, whatever. Maybe your spiritual advisors to help shape the rest of your life. I'll see you next time. Bye.